Right now, cable is coiling at exactly the level where smart money builds its shorts, and where retail gets squeezed. At 1.3278, we are ticks below the single most important number of the session, 1.3280. This is not a random line. It's a daily structural resistance, a moving average cluster, and a liquidity magnet all rolled into one. And I'm telling you now, there's one danger zone and one hidden opportunity sitting right there, and I'll show you both. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today, with exact entries, stops, and risk-reward. Here's the session verdict. The monthly chart says neutral, but the weekly is a strong sell, the daily is a sell, and yet, and this is the trap, the 5-hour and 1-hour are both screaming strong buy. That is not a reversal signal. That is a counter-trend correction within a deeply bearish structure, and it's approaching its limit. My intraday bias is to fade this bounce. I'm looking for rejection at the resistance cluster between 1.3281 and 1.3288. If price pushes above 1.3288 and holds on a closing basis, that's when we step back and reassess. Write this number down. If we break 1.3288 today and the hourly candle closes above it, the entire intraday structure resets and the trap flips. But as long as we stay below, the bearish gravity remains intact. Here's what matters right now. The herd is positioned long on the lower time frames, chasing this little pop. That means there is a thick layer of stop loss orders parked just below the recent swing low around 1.3246. Institutions know that, and they will engineer a move to hunt those stops. That liquidity pool is exactly where we want to be positioned on the right side of the trade. So today's playbook is simple. Sell into resistance, target the liquidity below, and protect capital above 1.3288. That single number defines risk-reward for the next several hours. Let's walk down the timeframes, because this is where the narrative gets really precise. On the weekly, the picture is brutal for sterling. Price has been grinding lower, and the 200-week moving average is way overhead. The weekly strong sell signal is driven by momentum that is far from exhausted. The daily chart confirms that. We are trading below every major moving average that matters. The daily 20 MA currently sits at 1.3288. The 50 MA is at 1.3357. The 200 MA is at 1.3368. Notice how the 20 has crossed below the 50 and the 200. We have a death cross structure on the daily, and price is lingering right beneath the 20. That 20 MA is acting as dynamic resistance, and it is coinciding exactly with our horizontal resistance A1 at 1.3281. This is a high confluence zone. When you get the 20 MA aligning with a horizontal pivot, the rejection probability jumps dramatically. Now look at momentum. The daily MACD is still printing negative at -0.006. The histogram is below the zero line, and there is no bullish cross in sight. The RSI sits at 41, not oversold. That tells me there is plenty of room for the sell-off to continue before any mean reversion trade shows up. The ADX is at 27.33, which tells us the trend is present but not overextended, so the directional move still has energy. The weekly and daily trends are aligned, and this 1-hour bounce is nothing more than a relief rally inside a downtrend, drop down to the 4-hour. The bounce we've seen is a classic retest structure. Price had been making lower highs and lower lows, then it spiked down to 1.3214, which is our S1 support, held, and bounced. But look at the candle bodies. They are small, overlapping, lacking conviction. This is not accumulation. This is distribution disguised as a recovery. The 4-hour strong buy signal is purely the result of that initial bounce off support, but it's losing steam as it hits the 20 MA on the 4-hour, which is also angled lower. And here's what most traders miss. The 4-hour MACD is still under the signal line, and the histogram bars are shrinking. That's a hidden bearish divergence. Price is making a higher low, but momentum is not confirming. That is fuel for the next leg down. Now the 60-minute chart. It's showing a strong buy, but that's just the short-term algorithm reacting to a series of higher lows. The 60-minute 20 MA is rising, currently around 1.3260, and it's acting as the near-term support for this micro uptrend. But that support sits exactly between the pivot point at 1.3246 and our first key support at 1.3214. So the 60-minute uptrend is fragile. If we lose 1.3246, and that is the pivot level, the whole hourly structure collapses and the move accelerates toward S1 and then S2 at 1.3179. The support and resistance levels we are working with today are precise. Resistance R1 is 1.3281, R2 is 1.3313, R3 is 1.3348. Support S1 is 1.3214, S2 is 1.3179, S3 is 1.3147. The pivot point that separates short-term bull from bear is 1.3246. That pivot is my line in the sand for intraday bias. Above it, the bounce can extend. Below it, the trap is sprung. Right now, price is flirting with a 1, and I expect sellers to step in aggressively, and let's tie this to cross-asset flow. The dollar is holding firm. We are seeing US yields creeping higher, and equity futures are struggling at resistance. That macro backdrop keeps pressure on cable. When the S&P 500 hesitates and bond yields rise, sterling gets squeezed. There's a negative correlation with risk sentiment on days like this, because the pound acts as a risk proxy, and when the dollar catches a safe haven bid on hawkish Fed rhetoric, pound sterling to US dollar gets hammered. So here's the technical conclusion before we add the fundamental catalyst. The daily trend is down. The resistance at 1.3280 to 1.3288 is the decision point. As long as we trade below it, the path of least resistance is toward 1.3246 first, then 1.3214, and then a full extension to 1.3179. A break above 1.3288 forces a rethink, but that is not the high probability outcome. The momentum, the moving averages, and the structural order flow all argue for selling strength. Now let's connect the last 24 hours of news directly to the price action you're seeing. The core story is right there. The pound is subdued as the dollar holds firm before Warsh remarks. This is not just a headline, it's a positioning event. The market is pricing in a hawkish lean from Fed Governor Warsh, someone known for a tight money stance. That expectation is keeping a bid under the dollar across the board, and cable is absorbing the pressure. At the same time, UK data this week has been sparse, leaving sterling without any domestic ammunition to fight back. The result is a one-sided drift where any sterling rally gets sold into. Think about the policy divergence. The Bank of England is in a much more cautious spot than the Fed right now. Rate differentials are widening in favor of the dollar again, and the 2-year yield spread between gilts and treasuries is tipping back toward the US. That spread is the hidden driver. Every basis point shift tightens the noose on cable. So when Warsh opens his mouth and even hints at the need for restrictive policy to remain longer, the dollar will flex again, and that 1.3280 resistance becomes a slingshot to the downside. The cross-asset linkage is loud. BTC is wobbly, hanging around a key level, and if it breaks down, it drags risk proxies like sterling. The S&P 500 is wrestling with its own gamma wall. Any equity reversal would pour into the dollar, and cable gets slammed. Even oil, with its geopolitical heartbeat, is feeding dollar strength through the inflation expectation channel. So the 1 to 2 week directional lean for pound sterling to US dollar remains bearish. I expect a test of the weekly S2 around 1.3100, as long as Warsh doesn't completely backtrack. The exact event that would invalidate this bearish lean is a daily close above 1.3357, the 50 MA, coupled with a MACD bullish cross. If that happens, the structure shifts. But until then, the default play is to sell rallies. I want you to do something right now. Do you think the dollar breaks 105 on the DXY this week? Comment yes or no. I'm tracking consensus. Because if DXY pushes through, cable's fall accelerates. This is your interaction trigger, and I pay attention to what you post. Most people skip this section. That's exactly where the money is made. Keep watching. I'm going to give you 3 setups, 2 scalps, and 1 swing, with exact numbers, and then I want you to comment whether you're scalping or swinging this week. The structures are clean, risk is defined, and they align with the institutional flow I've just laid out. Strategy 1, the opening scalp, scalping, high probability. This is the sniper entry that catches the first rejection at resistance. We are looking at the 5-minute chart. The condition is simple. Price taps into the 1.3280 to 1.3285 zone, which is the R1 resistance and the daily 20 MA, and then prints a bearish engulfing candle on the 5-minute close. The moment that engulfing candle closes below the prior candle's body, you are in short. Entry exact at 1.3282. Tight stop loss at 1.3295. That is just 13 pips above entry, above the local high and the 20 MA false break wick. Take profit 1 is at 1.3260, just above the 60-minute support and before the pivot, giving a swift 22 pips, which is a risk reward of 1 to 1.7. If momentum explodes, you can stretch a partial to TP2 at 1.3248. That's right at the pivot point, for a full 1 to 2.6 reward. What instantly voids this scalp? If the 5-minute candle after the engulfing closes back above 1.3288 with strong volume, you exit immediately. No second chances. This is a fast snipe, not a hold. The opening SALP entry, 1.3282, 5M bearish engulfing after tap into 1.3280, stop loss. 1.3295 take profit 1. 1.3260 take profit 2. Optional 1.3248 risk, reward, to TP11:1.7 are invalidation. Void if 5M candle closes above 1.3288. Strategy 2. The liquidity grab, scalping, counter noise. This one is beautiful because it exploits the stop hunt I mentioned earlier. Right now, the 1-hour chart is showing higher highs, and that invites breakout traders to go long above the recent swing high near 1.3288. But we know that level coincides with heavy resistance. So the setup is a fake breakout. Let price spike above 1.3288, grab the buy stop liquidity, and then immediately reverse with a wick rejection on the 15-minute chart. Your entry trigger is a 15-minute close back below 1.3288 after that spike, entering short at 1.3285. The stop loss sits above the wick at 1.3315, which is just beyond R2, giving you a 30-pip buffer. The target is a single, clean number, 1.3246, the pivot. That's a 39-pip move, risk reward of 1 to 1.3, but the win rate on liquidity grabs at this resistance is historically high because you're trading against trap longs. This requires fast execution, so have your order ready. Warning: if the breakout above 1.3288 holds for more than 2 15-minute candles without reversing, the grab has failed and you do not enter. The liquidity GRAB entry, 1.3285, 15M close back below 1.3288 after false breakout, stop loss. 1.3315 take profit. 1.3246 risk, reward. 1:1.3 are invalidation. 2 consecutive 15M closes above 1.3290 without reversal. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Strategy 3, the session swing, trend alignment. This is the trade that aligns with the weekly and daily bears, and it's meant to be held through the session, maybe even overnight. We need a trigger that confirms the rejection on the 4-hour chart. I'm looking for a 4-hour candle close below 1.3260, which is the near-term support and just under the pivot, with a bearish MACD cross on that time frame. Entry is executed at the close of that 4-hour candle, at market, around 1.3255. The stop loss is placed above the daily structure, above the R3 and the 50 MA, at 1.3355, a 100 pip stop. That's wide, but it's outside the daily noise and the 50 MA, giving the trade room to breathe. Target 1 is S3 at 1.3147, which is a 108 pip move and a 1 to 1.1 risk reward, but I want you to see this as a structural target. Target 2 is a stretch target at 1.3050. The next psychological support, offering 205 pips and a 1 to 2 reward. Once price reaches halfway to TP1, around 1.3200, you trail your stop to break even. And the explicit invalidation that would shift the medium-term outlook entirely is a daily close above 1.3357, the 50 MA. If that happens, the swing thesis is dead and we pivot to a range or even a bullish retracement play entry, 1.3255, for H close below 1.3260 with bearish MACD cross, stop loss, 1.3355 take profit 1, 1.3147 take profit 2, 1.3050 risk, reward, to TP11:1.1R. To TP21:2.0R trailing stop to break even at halfway to TP1, 1.3200, invalidation. Daily close above 1.3357, this is the 30 seconds that keeps you alive. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk, because the frequency is higher and the hit rate needs to be managed precisely. No positions through high-impact news, and that means if Warsh speaks and you're in a scalp, you flat out. Stops are non-negotiable. A 13-pip stop on the opening scalp is there for a reason. This is how you survive to trade the next big move. If you take away one thing today, it's this. 1.3280 is the level that separates the bounce from the breakdown. As long as we stay below, the pound is a sell on rallies. Tomorrow, all eyes shift to the US session and the aftermath of Warsh, if his comments reinforce the dollar bid, the floor drops out and the monthly trend might accelerate toward 1.30. If that level breaks, the whole monthly structure flips violently, and I will have the updated blueprint 24 hours from now. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Then hit the bell so tomorrow's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter.